Hello, 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 and happy Thursday. Welcome to yet another live event where we unpack multifamily investing, multifamily underwriting, one step at a time, one live event at a time. My name is Vessi Capulyan. For those of you who perhaps are meeting me or coming across this live stream for the first time, I am a former commercial lender turned real estate investor. And today I help business owners, high achieving professionals, family offices by connecting them with well vetted cash flowing opportunities in apartments for passive income, tax deferral benefits, and such. I also work with private investors to advise them on the complexities of the offering documents, doing second set of eyes, deal reviews, and such to help them protect their capital and minimize the risk of loss. And last but not least, for those willing to do a deeper dive and a little bit more work and willing to actually learn how to underwrite, I have a private community that also comes with a self-paced course that has helped many students at this point of time. So that's also something that I help with. But without further ado, I wanted to share with you my thoughts on some recent news that's been making the press and the real estate circles, private investment offering circles in the past couple of weeks, and namely the opening of retirement accounts to the possibility of private offerings beyond just equity markets and bonds, ETFs, and so forth. So I actually came across a very interesting article, and what I'll do is I'll share my screen so we can review that together. And I'll review the article with you, and here and there I will be pausing to share my thoughts because I think it's very important, very relevant, and while a cause for celebrations, there are some concerns, and that's the main reason why this particular article resonated really with me. It's published by Connect Money, and it's the democratization dilemma, retail investors, and the risk of private markets. It's very brief, so I'll highlight the key points. Historically, US securities law has drawn a sharp line between public and private markets. Public securities are open to all investors, subject to strict disclosure requirements, and actively traded on exchanges. Private markets, by contrast, have been limited to accredited and qualified investors with higher entry thresholds and far less transparency. Over the past 2 decades, this divide has widened. The number of public company listings has fallen from 7,000 in the late 1900s to roughly 4,000 today, while private fundraising under Reg D has soared, rising from 588 billion in 2009 to 2.15 trillion in 2014. Now, a big part of that shift is the uh, Job Cuts and Tax Act, which effectively increased access to or allowed access to such private offerings, including syndications, to the wider public. And what they're referring to here is that today there are different number of exemptions that that these offerings can be structured under to allow access to both accredited and qualified investors. Now, how accredited investors is defined today, at least, and mind you, that definition has not changed in a long time, is individuals making 200,000 a year if single, or 300,000 if joint over the past couple of years, past 2 years, with good certainty that this income will continue, or 1 million of net worth excluding the personal residence. And the definition is a lot more comprehensive, actually, but these are the two most common definitions that most private investors fit or individuals fit into. And I bring that up because, and why I made the comment it's outdated because just because you have the net worth or the income does not mean necessarily that that individual has deep enough understanding of what they're investing in, which is why I think it's extremely important, right, for the people who are offering those investment opportunities and securities and such to really take the time and qualify the investor, and maybe sometimes the answer is what they don't want to hear, right? That offering may not be suitable to them versus being solely driven by the desire to get them in a deal that may or may not be the right fit. But I'll continue on with the article. This has fueled perceptions that retail investors are being shut out of the most attractive opportunities. Side comment, that's an argument you often hear in syndications as well. Coupled with growing political pressure to democratize investing, regulators such as the SEC and Department of Labor are weighing reforms that could expand access to private funds. But according to a new white paper by Benjamin Bates of Harvard Law School's program on corporate governance, doing so without stronger safeguards could expose retail investors to hidden risks of volatility, illiquidity, and poor performance. Bates' paper, Retail Access to Private Markets, examines the rapid growth of investment vehicles designed to bring private market exposure to everyday investors. These include BDCs, non traded closed ended funds, and unlike traditional private equity funds, these products promise periodic withdrawals and net asset value, giving the appearance of liquidity. Yet, case studies show that promises can quickly unravel. Bates highlights the CION Investment Corp, which attracted nearly a billion while reporting stable returns, steady dividends, but in practice, CION restricted withdrawals in 2019, suspended them entirely during 2020, and when eventually listed on the exchange, traded at 30% discount to net asset value. Investors who stayed longest absorbed the steep losses despite years of smoothed net asset values reporting that suggested stability. And I'll come to that point in just a moment. The problem of smoothed returns. Bates' analysis shows that retail private funds tend to report low volatility and low correlation with public markets, making them look safer than they truly are. This effect comes from valuation models applied to illiquid assets rather than observable market prices. Traditional private funds often report returns with very low volatility, but these smoothed returns are a product of the fact that the fund's investments do not have observable market values and are valued using financial models, Bates wrote. Michael Underhill, CIO of Capital Innovations and member of Connect Money's Alternative Asset Investments Advisory Board, underscored the problem. Smoothed net asset values can mask volatility, leading to misaligned risk assessments. Asset liability management must adjust for this by using scenario analysis, incorporating unsmoothed proxies to better reflect potential drawdowns and liquidity needs. The white paper found that products marketed to less wealthy investors perform worse than those designed for institutional, ultra high net worth clients, also raising concerns of a two tiered marketplace. Bates noted this is particularly troubling as institutional allocations to private equity and venture capital have slowed in recent years due to weaker returns, suggesting that lower quality offerings may be redirected to the retail market. This concern is especially poignant now because in recent years, institutional investors have reportedly become more reluctant to put money into private equity and venture capital as returns in these asset classes have declined, explained Bates. Reported returns often appear competitive with high yield bonds, but adjusted for volatility, risk adjusted performance is frequently inferior to public markets. Exchange listed BDCs, for example, show volatility four times higher than their NAV based reporting would suggest. The drive to open private markets to retail investors reflects both political will and market demand, but without reforms in disclosure, liquidity, and oversight, retail investors could face significant losses. As Bates' research shows, the real question is not whether democratization will happen, but whether it can be managed responsibly to protect those least prepared for the risk. Retail investors expect periodic access to their capital, but private assets are inherently illiquid. ALM frameworks must incorporate liquidity buffers, redemption forecasting, and stress testing to ensure that funds can meet obligations without forced asset sales. If regulators expand access, safeguards should include investor suitability checks, clear disclosures, redemption gates, and minimum manager qualifications. These measures help protect retail investors while maintaining market stability. And if you guys would like a copy of the article or a link to the article, I'll happily share that with you if you couldn't capture that on the screen. But very, it resonated with me for the reasons that I shared, valid points that the Harvard professor raises. But as they say, there are two sides of the story. One is the people creating these offerings, right, to making sure that there are disclosures. And today, there are a ton of disclosures, right? In the syndication world, you get the PPM, which is like a 200-page legalese Bible. If you go invest in mutual funds and ETFs, they all have their prospectus, right, that you can read. But just because it's there and it's disclosed sometimes in a 2-point font doesn't mean it's easily understandable, digestible, and that the that the average investor can really get what's going on. And so when I say there are two sides of the story, one is the people putting this disclosure should really be not only taking the actions around disclosure, sensitivity analysis, and stress testing, which is really important, but making sure, right, that investors that are contemplating going into these opportunities, uh, that all of those are explained in plain English, something that's understandable to the average private investor. And conversely, for those of us who are private investors, is taking the time to educate ourselves and making sure we understand what we're putting our money into when those are really presented or those offerings are shared with us. And so there are a couple of ways you can get educated, right? Is especially if you know what asset class that you're looking into, is really go deep down. There are masterminds, there are courses that you can take. If you're looking into multifamily, that's definitely something that I've helped many people with, either on the educational side through the community course that I offer, or through the deal reviews that I do. These are one-off type of interactions to the extent you have a new offering, or maybe facing a difficult situation like a capital call that you're trying to decide whether to place more capital into or not, or pause distributions. I've helped many investors for that. So for those who don't really have the time necessarily to go deep and educate themselves, also the investment side, but also reading, right, the legal documents and disclosures. And the next best alternative is to hire a professional, right, whether that's an attorney to help you review the offerings, or an investment professional who can help guide you through the financials and the structure of the offering, mostly so you can, again, as investors, what's the number one rule that Warren Buffett shared? It's don't lose money, right? It's protect the downside, protect the principal. So that's also one of the main reasons why I keep popping up live on LinkedIn, and why I publish a ton of complementary content that's educational in nature, because it is one of my missions to create a tribe of educated and empowered investors. So I'm coming here sharing my experiences, sharing what I see out there in the market, and what I learn. And so while the whole premise of the article and access to more private offerings could be and is a cause for celebration, I agree with the underlying premise of the article that it needs to be done responsibly. And with certain legal guardrails in place to ensure that both the people or the sponsors selling these investments are doing it in an appropriate manner and not necessarily laying it heavily with fees on top of fees on top of fees, and really being incentivized then to push these investments due to the fee income this produces. And conversely, for investors, just because it's sold to you as now you have access to what the top 1% has always had access to, really learn how to peel the onion, so you can one make your own decision and reach your own conclusion of whether or not that's a good fit for you, and if it is, right, if it's a strong enough investment to warrant you placing additional capital in it. So that topic around due diligence is something that I actually talked about last week. So last Thursday, which is why I couldn't do a live then, I had an in-person presentation here with a local real estate organization where I shared the top three steps that I take when I vet deals, and shared a ton of life stories, case studies, examples. Some of them with a happy ending, others with not so happy ending, but those were valuable lessons. And then on Friday and Saturday, I had the pleasure of participating at the InvestX Global Summit, where I continued on the topic of due diligence, specifically from a passive investor's perspective. So hopefully that was helpful for you today. And if you do have any questions around evaluating multifamily deals, multifamily underwriting, or need a second set of eyes, simply send me a direct message and we can connect. And if you like to stay abreast of any future pop-up live events, educational events that I host, I would encourage you to follow me on LinkedIn and YouTube and subscribe to both channels so you can get notified early on. And I wish you a blessed day. Thank you.